Have you ever wondered why your money buys much more in some countries than others? Let us look at how economists measure this. Purchasing power parity, or PPP, is a concept used to compare the true value of currencies across different nations. At its core, PPP suggests that an identical basket of goods should cost the same in every country after adjusting for exchange rates. Investors and economists use PPP to see if a currency is overvalued or undervalued relative to another. Market rates shift constantly due to trading, while PPP provides a long-term view of what money is actually worth. When we adjust for PPP, we can see the real difference in purchasing power, even if the nominal exchange rate suggests otherwise. It is important to remember that this is a theoretical tool, not a perfect forecast for day-to-day currency movements. Understanding global economics helps you see the bigger picture of how money works. Thanks for watching and stay curious.